In 2000, over $22.021 trillion in mortgage-backed securities, commercial real estate loans, and treasuries were sold to insurance companies and banks. These loans remain on banks' balance sheets. When interest rates increased from 0% to 5% in 13 months, the loan's value dropped to between 75 to 85 cents on the dollar, resulting in massive losses. Our 21 Lehman systemic risk indicators show the highest chance of a crash or sharp drawdown in equities markets within 60 days. The Nasdaq is ignoring credit risk, as seen before COVID and Lehman. When a shock occurs, credit markets price in the risk, but equities don't. The LDI scandal in London occurred in October, followed by stress in regional banks, Credit Suisse, and elevated Deutsche Bank CDs. MetLife, Lincoln Financial CDs, and impaired commercial real estate loans were also affected. Capital One CDs, representing consumers, are now at multi-month wide, indicating a rolling credit crisis. Do federal authorities recognize this and have any solutions? Mr. Powell, chair of the Federal Reserve, appeared nervous at the end of the last press conference. Bill Eastman pressed him on these issues, and Powell is aware of the underlying problems. The Fed is focused on fighting inflation, a public narrative they maintain with the White House. This situation is similar to 2018, with rising credit risk threatening to veto the Fed's policy path. This is like 2018, not 2008, with a significant differentiation. The New York Stock Exchange stocks above the 200-day moving average were at 71% in February, indicating a strong bull market. Now, it's down to 38%, similar to December levels. It's not a Lehman event, but a slow-moving credit crisis as the Fed fights it with liquidity. It's spread out, with banks, insurance companies, and others owning bonds priced at par with 1% coupons. Interest rates are now 3 to 10% across high yield, and bonds sold to investors at 1 to 2% are now in the 80s on bank balance sheets.